Welcome to PhillipCapital's Weekly Market Watch. There has been recent reports that the US economy is showing signs of deflation. Is that possible? Let us hear from Mr. Dexter Tan, investment analyst from Phillip Securities. So Dexter, what is the basis of such reports?
Last Wednesday, the US Labor Department reported a drop in the US Consumer Price Index. It was a 0.4% year-on-year decline in March. The US Producer Price Index has also declined 3.5% year-on-year in March. This is the first time that the US Consumer Price Index has a year-on-year decline since 1955. Some people have used the numbers to debate that the US economy is in a deflation mode. But I don't think so. I think an inflation scenario is still probable in future.
Why is that so?
First, governments have been implementing fiscal stimulus measures in a bid to revive the economy back on recovery. This is usually done by cutting taxes and increase government spending. By cutting taxes, in theory, people will have more disposable income, and therefore they will spend, and this will lead to higher price levels and higher aggregate demand. In the 2006 IMF paper by Choi and Devrux, which studies the asymmetric effects of government spending and real interest rates, they have discovered that government spending will lead to positive, significant impacts on aggregate spending in a low real interest rate environment, but will not have much impact if interest rates are trading at high levels. Given that Treasury interest rates are trading at low yields right now, the probability of an inflation scenario in future is more probable. Second, the UK Telegraph has reported that China has been buying raw materials recently. They have been buying copper and industrial metals in a bid to diversify their US Treasury holdings as well as to prepare themselves for the next industrial revolution. Given that China has the world's largest reserves and is buying commodities, the scenario for inflation in future cannot be denied.
As such, what do you favor in the market right now?
I like commodities in the short term. I think commodities are a good hedge against inflation. Expansionary monetary policy as well as excessive money supply can lead to inflation in future. If China is buying commodities with their reserves, I think the commodity market would be supported. I think moving forward, buying commodities on dips makes sense. Investors who are interested in commodities can look at futures, unit trusts, or exchange-traded funds which invest in commodities.
Thank you, Dexter. That's all we have for you today. Tune in next week for more market updates.